So I'm here with Joe Trevino, a mortgage specialist with Thrive Mortgage. Joe, I got a question for you.
Sure.
Let's say there is a home buyer that wants to purchase a house, and let's say did not have the max amount of income they want to make in order to purchase the house.
Okay.
So they have a family member that want to help purchase with them. How would that process go if someone wanted to do a co-sign on?
Okay. And, that's a good question, because we're seeing a lot of that today with the higher interest rates, higher price of homes. Unfortunately, a lot of blue-collar workers no longer qualify. So we're seeing more of is a parent, a brother, aunt, uncle, sister, someone else will come on the loan with them. So the same requirements apply to that co-borrower. They're basically going to be a non-occupying co-borrower.
Non-occupying. What does that mean?
No, they're not going to be living in the home. It's not going to be their primary residence.
So they're on the loan.
They're on the loan. They're on the deed of trust. They have the same responsibilities that the buyers have that are living in the home.
Right.
So it affects their credit, and they're responsible if the primary borrowers do not make that monthly mortgage payment. The co-borrowers are responsible for that. And if the borrowers fall behind, it affects the co-borrower's credit as well. It's a responsibility. It's almost as if they're buying the home for their own purposes.
Yeah.
What I tell a lot of people, especially the young couples, is as their income increases, and if interest rates drop in the next 2-3 years, they can always refinance that home into their own name and remove the co-borrowers from the mortgage.
So maybe someone right now in today's market can use a co-borrower to purchase a house, and then a strategy later is to refinance them out.
Correct. Refinance, and let them know that, if their parents are helping them on the loan, as their income, the buyers, the ones that are living in the home, as their income increases and their debt drops, that affords them the opportunity to refinance it into their own names.
So what would be the pros and cons of having a co-borrower?
Well, the pro is that you can definitely take advantage of buying today. Again, as you know, you're the expert. Home prices continue to increase here in San Antonio.
Right.
We don't see them going backwards anytime, and I don't see that ever happening, quite honestly.
I agree.
So that's the first advantage. They can take advantage of the home price today.
Yeah.
The second advantage is that they have ownership in a home. They're able to write off taxes and interest on their tax returns now because they are now homeowners.
Right.
The negative to it is if anything happens to the primary buyer's employment or anything like that, the co-borrowers are responsible for that loan.
Yeah, I see.
And I'm always very, very upfront with the client. If it's a parent or if it's a brother, whomever's coming on as a co-borrower, I let them know, there's the responsibility of this is going to go on your credit. You're responsible for this loan if they cannot make the payments.
Joe, when you hear the word first-time homebuyer program, right, first-time homebuyer loan, what are your initial thoughts when you?
It's someone who has heard bits and pieces of first-time homebuyer programs. They don't understand how it works. A lot of people think it's just free money out there. That you're just because you're buying home for the first time.
Or let me ask you: is there a loan called first-time homebuyer?
There are some loans that are structured around that. Yes, but when I hear someone tells me I'm a first-time homebuyer, a lot of times they think there's no down payment, no closing costs. They're coming to the table with $0, and they're getting into a home free. Yeah. You and I both know that doesn't happen.
Yeah, it doesn't happen.
We
all be buying houses.
Exactly. So, it's a matter of just educating them and letting them know, find out, okay, so you are a first-time home buyer. When we go through the loan application process, I let them know what the requirements are in order to purchase a home.
Right.
And then, once we go through there, we find out about their assets, what they have available to them. I let them know that if they don't have money for a down payment, there are programs that will assist them with that down payment.
The down payment, but there's more than just the down payment costs.
What's the closing costs?
What does that entail?
Closing costs are 3 different categories. It's what the mortgage company, what my company charges to do the loan, the title fees, what the title company is going to do to insure the loan and process the loan and close the loan, and then escrow, which is property taxes and homeowners insurance. So those 3 components form the closing costs.
So the total cost of buying a home is a down payment plus the closing cost, which includes those 3 things.
Correct.
So why is there a misconception that a first-time home buyer thinks that we can kind of get them in a house with 0 down payment?
Well, I think a lot of it is just, the lack of knowledge. People really don't know about closing costs. I mean, people don't buy homes like they buy shoes or even cars.
Right.
Buying a home is the single largest investment that most people are going to make in their lifetimes.
Right.
I mean, you'll buy numerous cars through your lifetime.
Right.
You're going to buy 1, 2, maybe 3 homes through your lifetime. And each time, if you do that, you're probably going up in price.
Wow. Let's say someone who's had bought a house like 3-4 years ago and it wants to upgrade a house or wants to move to a different side of the city.
Right.
Are they eligible for this first-time home buyer programs?
Yes and no. There's different programs that will allow you to. So these different programs are grants that the state of Texas has. Mm-hmm. There are programs that will allow you to utilize the funds to purchase a second home as a first-time home buyer, where they'll assist you with the down payment.
Yeah.
What a lot of people don't realize, and this is part of the education process, is that those bound programs, they set the rate. I don't set the rate. My company doesn't set the rate. That's how they're making their money. They're setting the rate. So you're going to pay a higher interest rate in order to get that down payment assistance.
I see.
Yes, to answer your question, if you've had a home previously, you could still get down payment assistance moving forward. If in your scenario, if they've had a home previously, I would highly recommend that they not do that. That they get a better interest rate. They're going to make money on the sale of their previous home, and that's where that's where educating the buyer comes in.
So no one person has the same circumstance as another.
Absolutely.
And it's totally different.
Each one is different.
Yeah.
Each scenario is different. I mean, that's one of the joys of this, of being in this industry, is that no 2 days are alike.
Yeah.
Every day I'm talking to people. It's a different scenario, different reasons for them wanting to buy, different reasons for them either moving to San Antonio, whatever. It's what makes the job fun.
Yeah. What do you see as the most common loan products that local people in San Antonio are using? And then is there a loan product that is out there that you know of that not a lot of people are taking advantage of?
Good question. So I see most of the loans that I personally am doing are FHA loans. FHA loans is the most lenient loan product out there. And when I say lenient, is the ratios are a little bit higher.
What's the
ratio? Most first-time home buyers, ratios are what your debt to income is. And debt to income is explained pretty easly. When we order your credit report, it's going to let us know what your monthly liabilities are.
Based off the credit report.
And we're only looking at automobile loans, credit cards, student loans, personal loans, etc.
How do medical bills play a role in that?
Medical bills are not going to pop up on your credit report unless they've gone to collection.
Understood.
But if you're current, like on a care credit card or something, it's going to show up as a credit card.
And
it'll show up, on your credit report. So we add the total monthly amount of your liabilities, and we add what a proposed new house payment would be. Add those two together. That gives us a grand total. We then divide that by your gross monthly income, and that's your debt to income ratio. An FHA product cannot be higher than 55% on debt to income.
So your debts can be as much as 55% of your income.
Correct. Debt with your house payment.
Including the house payment. So if you're already at 55% and you want to buy a house, you can't afford it.
Not going to happen.
But what if I make high income, Joe?
If you make high income, you have high liabilities as well, which again, the government has done this intentionally, Dario, because they don't want the crash of 2008 to occur again.
Yeah.
So they've enforced these guidelines that all lenders have to abide by. These are FHA guidelines. It's not what my company or I individually do. So I explained that to the buyer. So once they understand that, what their monthly income is, based off their debt to income, we can then let them know how much home they qualify for.
So
so that was the question is FHA's first.
Okay.
I personally probably do, secondly, VA loans. Because of the fact that San Antonio is military city, USA. I do a lot of people that are active duty that are getting PCS transferred into San Antonio. There's also a lot of veterans that have retired in San Antonio because of the cost of living here, because of the fact that we have the VA hospital, the commissaries, etc. And VA loan is an incredible product because there's zero down payment, there's no mortgage insurance, and 9 times out of 10, it's at a better rate.
Wow.
So it's a great product. If you're a veteran, I highly encourage you to take advantage of that product. There's a lot of veterans, unfortunately, that haven't done for what
But there's still closing costs.
There's still closing costs involved, but it's not as high because there's no mortgage insurance.
Oh, I see. So you just pay property taxes.
Exactly.
Escrow.
And for veterans that are 100% disabled, there's zero property tax. They pay no property taxes whatsoever.
So
it's
VA,
just mortgage, the principal and interest, and homeowners insurance.
Yeah. So
that's it.
It's a big deal in Texas because our property taxes are expensive. You're paying anywhere from like $700 to like $1,000 maybe, depending on the area.
True.
A month just for property taxes. So someone with the VA, 100% disabled, doesn't have any costs, any closing costs?
They're minimal.
Very minimal.
I mean, you're still going to have, escrow with your homeowner's insurance.
Yeah.
And they're going to have title costs. And then, our origination costs.
Yeah.
My company, Thrive Mortgage, for all veteran loans, whether they're active, retired, we don't charge an origination fee.
Oh,
wow. It's a great product for a veteran to take advantage.
That's a big deal.
So the other loan that most people don't know about that I highly recommend is a USDA loan. And a USDA loan, it's much like it's an FHA loan guaranteed by the government, but it's also a loan product that has zero down payment.
Interesting.
But it's for homes that are outside the city limits of San Antonio. The program was created to help these smaller towns from dying off. So the government said, we'll come in here and help you. If people will purchase homes in these markets, we'll finance them at 0% down payment.
And what's the range in San Antonio? Like, is it Castroville?
Castroville's eligible, Seguin's eligible, Poteet, Pleasanton, Floresville. There's a USDA map that I go to, and you just give me an address. I plug it in. It'll tell me whether that's a USDA eligible property. But I've done many of those loans over the last 5 years, and it's at a lower interest rate, zero down payment, lower mortgage insurance. It's a great product.
This is a great product for someone who wants to move outside.
Exactly. There are some loan requirements. The government doesn't want you to have a lot of debt. They just want you to be responsible because, they're going on a limb with you as well. But it's a great product.
And what's the other one? You have FHA. You talked about VA, not USDA.
Conventional. And then I have some products that are non-conforming. I can do bank statement loans as well. But conventional is one. It's the program that I recommend for a scenario that we just talked about. If you're selling your current home, you've got good down payment, you're going to go into a higher priced home that's a bigger home, maybe in a different neighborhood. If you have the ability to put 20% down, there's no mortgage insurance on a conventional loan.
Can you put 20% down on an FHA?
You can. I don't recommend it. I mean, it's not really going to help you in the long run. I would rather, I'm not a financial advisor, but most financial advisors would tell you not to put 20% down on an FHA loan. They would say to put the minimum down and have that money make you money doing something else. So
let's talk a little bit more about conventional. Why would someone want a conventional loan over an FHA loan?
There's no mortgage insurance. If you don't have the ability to put the 20% down, once you've paid 20% down on that loan, the mortgage insurance goes away.
What about
on an FHA loan? It's there for the life of the loan.
Really?
Yes.
So you can almost pay off the house, but you're still
paying mortgage insurance, which is why I don't recommend that. So a lot of times in my initial consultation, I'll ask the buyers, how long do you plan on staying in this home?
Yeah.
If they tell me they plan on staying in the home, 3 to 5 years, then I'll recommend an FHA product. I can get them in, at a lower rate up front, less down payments, and there's less dollars coming into the transaction.
Yeah.
Again, they're only going to be there for 3 to 5 years. Yeah. It makes sense. And if this is going to be your lifetime home, the last time you're going to purchase, well, then I'm definitely going to recommend a conventional product because once they've paid that 20% down, there's no mortgage insurance.
Right. I have some questions for you. Let's say there's someone who wants to buy a house and doesn't know how to get started, right? And maybe doesn't know a real estate professional like myself to call and talk to. And maybe he's watching this and is thinking, how do I know if I can afford a house in San Antonio? Now, I heard costs of houses are rising. Like, my job hasn't given me a raise in a while. Like, as a loan officer, mortgage specialist, what do you look for in the qualifications of being able to purchase a house?
So when that's a good question, Dario, because there's a lot of people out there that don't know what the process is. So if I'm talking to somebody for the first time, I let them know what the requirements are in order to qualify. So you've got to have permanent income. Have at least a 2-year history of working full-time, and you've reported taxes for the last 2 years.
Yeah.
At your job, you get paid either weekly or biweekly, but you've got monthly income coming in.
Yeah.
Have a credit score of at least 580 or better. and I'll ask someone, have you had your credit checked recently? Who did it? And they'll tell me it's on Credit Karma.
Yeah.
And I let them know the Credit Karma is not, a legitimate source. It's a good reference point,
right,
but it's not a hard credit pull.
Yeah.
And then lastly, I'll let them know, that they're going to need money for a down payment and closing costs.
Closing funds.
In order to purchase the home. And then if they tell me they think they've hit all of those points, I can let them know that we can do the process one of three ways. I can send them my application via email or text.
Yeah.
I can take their information over the phone right then and there, or they can come into my office in person, and we can do the transaction in person. At that time, whether it's done via the application, the phone, or in person, I'll do a credit pull. I'll share it with them, and we'll review their credit report together. Make sure that everything on there is accurate. Once they give me their income, pay stubs, tax returns, and bank statements, I'm then able to see, I can verify income, I can verify their assets, let them know what they qualify for.
And that's kind of like the general process I like to see. So if someone's been working for a year and a half, they probably can't qualify. If someone has been working, has great income, but has a credit score of 500, probably can't qualify.
What I say is that we can't do it right then and there.
Right.
However, there's some, we'll take some steps. I will let them know, look, the reason you cannot qualify right now is because these 3 credit cards that you have are all maxed out.
Yeah.
I explained to them how credit cards work.
Right.
If you pay these balances down to below 10% of the limit, if you can do it quickly, I can get a rescore. If it's going to take you 30 to 45 days, that's fine. Once you've done that, we can rescore you.
Yeah.
My simulator will tell me how high their score will go up once they pay those credit card balances down.
So there's not one way to do it. So would you say it's important for people to either talk to a mortgage specialist or a real estate professional early on as soon as possible?
Most definitely.
That way they can kind of create a game plan.
Correct. Otherwise, you're navigating waters that you don't really know what you're doing.
In the dark.
And a lot of people think that, well, I made my payment on my credit card. I'm paying the full amount every, $25 or $30.
Yeah.
But they're still maxed out on that credit card.
Right.
It's not helping them at all.
Yeah.
Unfortunately, personal credit finances are never taught in school. People don't know how important it is to take care of your credit, because that credit follows you for the rest of your life.
Well, let's do a deep dive into that. As a mortgage specialist, someone who looks at a lot of applications, what do you see are some of the most common pitfalls of someone with bad credit? And what is considered bad credit?
Bad credit is, in my opinion, is credit scores in the 500s. And inevitably what I see is a lot of young couples go to college and they get bombarded with credit card apps. Credit card companies are offering all these college students credit cards, and these individuals unfortunately get into trouble. They're not responsible enough. They charge, and then do not make their payments in a timely manner, which affects their credit score. Secondly, I see a lot of college people graduate and go buy a $50,000 car and have an $800 car payment, and they can't qualify to buy a home. Because they've got too much debt. I think young people, cars are flashy, they're nice, but cars have also gone up in price, and I'm seeing young college students with $800-900 car payments, and it's just that used to be a house payment.
Yeah, I know.
Not too long ago.
Right, 10 years ago that was a house payment.
Exactly. Now that's a car payment. So I think it's just not being responsible, not doing their research, not being forward thinking and knowing that I want to buy a home, in my 20s, and unfortunately they can't because they have too much debt.
Does someone need to make $100,000 a year in order to buy a house?
No.
So is there a misconception that you need high income to buy a house?
Yes, there is a misconception on that. There's also a misconception that you need 20% down to buy a home. There are so many. Again, a lot of this isn't taught, Dario, but if you don't, you could make $60,000 a year and buy a $200,000 home.
Yeah.
It's 3.5% down if you go in the FHA route. If you've got good credit score, you don't have a lot of debt, you can qualify.
Yeah. That's the key, right? Good credit score, little debt.
Correct.
Yeah.
And that, believe it or not, that's not a common thing. We don't see a lot of that, unfortunately,
Well, let me ask you, what's been your most kind of impressive credit application profile? You don't have to say a name.
Right.
But when you got this application, you're like, wow, this is a unicorn. I've never seen
Sure.
that. Seen them.
No,
what did that profile look like?
It was a couple in their early to mid 30s.
Yeah.
They both had 800 FICO scores. They both had no debt. I mean, they had credit cards that had $10,000 limits and their balances were $100.
Yeah.
Had good income. They're both, stable income. And I've done loans for couples in their 30s that are buying $500,000 homes.
Wow.
And they're responsible. They manage their credit, responsibly. They're not in debt. They have good income, but I think most importantly, they're responsible.
Yeah, and it's a reflection.
Correct.
It's a reflection on the
absolutely 100%.
What's been the scariest credit application where you're like, oh man, I don't know how to break it to this person, but and what did that look like?
Well, it's again, I'll use an example of a young couple. They're both in their 30s. They both have incomes that are in excess of $100,000
each. Wow. Yeah.
But by the same token, they've got like $6,000 in monthly debt.
Wow.
It's just, they each have expensive cars. They have a boat. And they have, jet skis and the RV and so forth. And they're maxed out on credit cards. And they can't qualify to buy a $400,000 home, and they don't understand why.
Right. Yeah.
Again, the government has imposed these guidelines on us. And
yeah.
If you cannot qualify on paper, we're not going to give you that loan.
Right.
No matter how much income you have, but if you've got all of this debt, you don't qualify.
Right. Right. So high income, high debt,
exactly.
No go.
And again, I've seen young couples, again, 30-somethings, that have the income and they have bad credit.
Yeah.
That's what's just mind-boggling to me.
Yeah.
You're making $200,000 a year and you're behind on credit card payments.
Yeah, it's incredible.
To me, that's just there's lack of maturity, responsibility.
Yeah.
You shouldn't buy that $400 home because you're going to fall behind on that as well.
Right. Let me ask you a question. You mentioned this earlier, non-conforming loans. Who would be the type of person that would go after this type of loan product, and what does this loan product entail?
Okay. The most popular non-conforming product is what they call a bank statement loan.
Bank statement loans.
And a bank statement loan is a program where we don't look at someone's tax returns.
Yeah.
People that fall in this category are people that are self-employed. They're 1099 incomes. Mm-hmm. They're generating $200,000, $300,000, $400,000 a year in income, but they're writing the bulk of it off.
Right. Yeah.
And they're showing a net income of $20,000 or $30,000.
Yeah.
On paper, tax return wise, they're not going to qualify for anything.
Right.
But they're cash rich.
Right.
They just refuse for whatever reason. They're not, getting the proper tax advice.
Right.
They're going to a tax preparer or
And
whatever they're doing. But they know what they're doing.
Yeah.
So a bank statement program, as long as your credit score is above 660, which means you're responsible, you're paying your debts, and you've got the ability to put 20% down. We can do a bank statement program, and what that entails is we get your last 12 months of your bank statements. We look at your deposits. We add those up over 12 months, divide that by 12, and that gives us monthly income.
So it's really important that all revenue goes to one account. Otherwise, you got to get all of the accounts.
Correct. And the 20% down you would think would be a hindrance to most people, but again, these people are cash rich.
Right.
They're in a cash business. So I've done numerous bank statement loans for people that are buying homes that are $200,000-$300,000.
Yeah.
And they have the $40,000, $50,000, $60,000 to put down. So they're basically financing. It's an 80% of the price of the home.
So it is possible to get a mortgage even if you are not filing your taxes, let's say appropriately or
correct.
Or
that is true.
But this is this doesn't make sense to someone who has small income, right?
Right. No, it's going to be. They don't have the ability to come up with 20% down.
Yeah. And the credit score needs to be at 660.
Right. And you're going to pay a higher interest rate as well.
Oh, that's important.
Because that's important. So what I tell people, if you want to do this and take advantage of the price of the homes today before they continue to go up, and if you start reporting your taxes correctly and show that income and pay the taxes, and you've got $75,000 in income this year and $120,000 the next year, you can refinance this bank statement loan in 3 years into either an FHA or conventional loan.
Yeah. So there's strategies and
right, and when you refinance it, you're going to lower your interest rate.
Yeah. What are some of the most common misconceptions you think people have about purchasing a house in San Antonio?
That you need 20% down.
That you need 20% down.
I think that they've heard their parents say that, their grandparents say that. For whatever reason, they've heard that you need to have $100,000 or $75,000 in the bank in order to buy a home. That's not true. I mean, you can, as I said, you can get into a home with FHA with 3.5% down. You can buy a USD home with zero down.
Yeah.
VA loan with zero down. Yeah. But again, that being said, I mean, you do need to have money in the bank. Yeah. You need to have assets. I mean, there are closing costs. Mm-hmm. You're going to incur some expenses when you buy a home. I mean, you know this as well. Yeah. I mean, you have to do an inspection.
Right.
You've got to pay for an appraisal up front.
Got to get the earnest money.
Exactly. Yeah. So, you cannot come into the scenario with $0.
Yeah. So that's another misconception that you can be negative in a bank
Correct.
and buy a house.
Correct. No, not true at all. You do have to have assets in order to purchase a home.
Assets includes cash or what's an asset?
I mean, cash, savings, a 401k, a retirement program, stocks, bonds, etc.
I see. What are your thoughts in the culture of interest rates talk? 2 years ago we were at somewhere unbelievable.
Correct. People
think that we're either I hear two sides. Oh, we're going to like 9-12%. It's never coming down. I hear other opinions. Oh, you just wait a few more months, it's going to come back down to 3%. Like, what are your thoughts as a mortgage specialist? And what do you guide your clients to do?
I think that for the most part, people have short-term memory.
Yeah.
They remember, as you said, what rates were during COVID.
Yeah.
The threes and so forth. They don't remember what the rates were pre-COVID.
Right.
Pre-COVID, we were in the 5s. We were in the 6s as well.
Yeah.
I think COVID was an anomaly. I personally don't think we'll see rates in the 3s and the high 2s again.
Right.
I mean, the government did that intentionally because of COVID. What I'm recommending to people, and again, I don't know. I don't think anyone knows, if we're going to go to 9. I definitely know that we're not going back down into the 3s anytime soon.
Right.
That being said, what I'm telling people, and I say this to them every day, and I truly mean it, is that if you can afford to buy the home today, I would say buy that home today.
Yeah.
Because we all know that the price of homes is going to continue to go up.
Right.
If and when rates do come back down, you can always refinance the loan into a lower interest rate. But you're going to pay more for that home in 2 years or 3 years than you would today.
So if individuals look at their income and how much they can afford, right? If they have a budget, then they can qualify to buy a house,
right?
And then work within that kind of price range.
Correct.
Yeah.
Correct. And the other thing too, that is, if they buy today, they're able to take advantage of the tax benefits when they do their taxes next year. They're homeowners; they can write off, taxes, interest.
Yeah, and also save money on property taxes.
Exactly.
When
they file their homestead exemption. Yeah. Correct. Otherwise, I mean, you continue to pay someone else's mortgage if you're renting a home.
Yeah.
Or if you're paying in an apartment, you're essentially throwing your money away.
Yeah. So we've been talking about different loan products, different case scenarios. But let's talk about a little bit about you, Joe. Who are you, and what do you do?
My name's Joe Trevino. I'm with Thrive Mortgage. I'm a residential mortgage loan originator, which means that all I do are mortgages. I purchases and refinances. That's all that we do.
So you spend all day, every day a week, kind of helping people, with these applications.
And what I look at it's a partnership between me and yourself as a realtor and the other realtors that I work with, because I feel it's a team concept. We're working together as a team to help our clients get into their home.
Yeah. What do you see since you partner with realtors, it's kind of like you have partnerships. What's What's like the worst case scenario, and when someone's trying to work with you, and what's like a best case scenario when it talks about other real estate professionals?
Right. I think that sometimes realtors can kind of get out of their lane and start giving people mortgage advice when they really don't know what they're talking about.
Yeah.
I always, people will ask me, well, what do you think about this neighborhood, or what about this school district? And I say, your realtor is the expert at that. They're the ones that know about the neighborhoods and the school districts.
Right.
I truly don't. I look at zip codes and the numbers on what the home is. That's my focus is just to help. I let them know that I handle the mortgage, the boring part of it,
Right.
if you will.
Yeah.
And the realtor gets to do the fun part,
Right.
showing you the homes,
Yeah.
getting you the home, et cetera. I think, it's important that we each stay in our lanes and work as a team in that regard.
Mm-hmm.
I think one of the other things, too, is that a lot of realtors, for whatever reason, will lead off with down payment assistance.
Yeah.
And so the
Guaranteeing
buyer,
something they can't.
exactly, the buyer then thinks that they're having to come to the table with no money.
Yeah.
And so once I have to re-educate them on how this process works,
You become the bad guy.
Exactly, exactly. So I think it's important that we each stay in our lanes and work together in that regard.
Now, on the opposite spectrum, what is a real estate professional relationship that you find is very valuable in bringing you income or bringing you your business?
Sure. When you as the realtor do a little bit of the interviewing your client, you know that they're employed, that they've been filing taxes, and that they're legitimate clients.
Yeah.
I've had realtors send me people that are unemployed.
Yeah.
And it's just like, how do you plan to purchase them if
Yeah.
you don't have
Like,
any?
you didn't ask that question.
So it's like and again, I don't want to say that all realtors,
Right.
but there are some realtors that if that person is living, breathing, they qualify to get into a home.
Yeah.
And that's not the case at all.
Right.
I think that, we're all professionals.
Right.
It's just a matter of just doing a little bit of homework, if you will. Just doing, interviewing the process. So you, for example, you and I have done numerous transactions together.
Right.
But you take it upon yourself to do an interview with your client. You know that they're employed. You know that they have the ability to purchase, or if they're selling a home, et cetera.
Right.
And you give me that information prior to me talking to the client. So that's extremely helpful to me, so that I'm not walking in cold.
Right.
I know a little bit about your client. It just helps me, prepare and have a more successful initial interview.
Right. As opposed to you being the bad guy.
Correct.
Right.
Correct. I don't know why some people just they lead off with there's down payment assistance on and you don't have to worry about the money, and that's not true.
Yeah. Well, in the real estate industry, right, on the agent side, the salesman side, like there's thousands of real estate agents in San Antonio, so the level of competency, is also a spectrum when it comes to being an agent. And I would imagine the same is for a loan officer.
Yes, I would say so. Yes, I would definitely agree with that.
So what do you find some successful traits in like a loan officer, and what has made you successful?
I think that number one, I'm very diligent, highly self-motivated, organized, and I'm flexible. My wife and I are empty nesters, so I have the ability to work on the weekends,
you have time.
Evenings, exactly. I make myself available because, again, I know, much like you, Dario, that we have to work around our clients' schedules.
Yeah.
If they're school teachers, if they're doctors, attorneys, pharmacists, or even blue-collar workers, truck drivers, they have their work schedules, and we have to work around their schedules. So I make myself available, try to make it as easy for the client as possible. Some clients, prefer to meet in person, and they can't during working hours. I'll meet with them after hours during the week, or we can meet on Saturdays at my office. I'll go in and open the office on Saturday, and they can come in. I think one of the other things that has helped me personally here in San Antonio is that I'm bilingual. So I do a lot of Spanish-speaking clients, and they, because of the cultural differences and nuances, they prefer to do things in person.
Yeah.
So they're not going to email or upload their documents or anything like that. They're going to hand carry their tax returns, pay stubs, bank statements, and everything, and they'll come into the office, which is fine. I have no problem doing that, So we'll take care of them in that manner as well.
Nice. Well, Joe, it's been a pleasure, man. I feel like I can speak with you for hours and hours and hours. But if someone wanted to get more information on, if they're curious do I qualify to buy a house? How can I get a hold of Joe? Like, what's the best way?
Call me. I pick up my phone 7 days a week.
Nice.
210-542-6612. Or they can reach out to you, Dario. You know how to get a hold. You can get them in connection with me.
Awesome. Well, I'll put that information on the description. Thank you for your time, Joe. It's been a pleasure. And we'll probably have you back again, talk more real estate related talk.
I enjoyed it, Dario.
All right.
Thank you very much.
Cheers.
Cheers.
And